Hey, what's up, guys? So I wanted to do a video for a couple of my friends that had expressed an interest in wanting to learn how to trade. So basically, this video is going to be directed towards the absolute beginner, somebody that has never really traded stocks before and is just kind of looking to get into it. So let's just get going here. So when I first started trading, I was using an app called Robinhood. Robinhood is great because there are no commissions, so you can buy and sell stocks for free. Basically, they have a pretty good mobile platform, so you can trade from your phone. So right now, obviously, I'm on my PC, but for somebody that's first starting to get into it, it's a great way to just kind of break the ice. So you can see I don't really have a lot of money in here right now. I actually trade on the futures market, which is a little bit different. We can certainly get into that later, but yeah, right now the stock market is extremely volatile, and generally, if you kind of know what you're doing, where there's volatility, you can make money. So you can see these are just some of the stocks in my watch list here. A couple of these companies are Tesla, Disney, AMD, Activision, Blizzard, Nvidia, Sony. SPY is the S&P 500, or the 500 biggest companies in the U.S. stock market. This is one of the most widely traded stocks that are available. So a couple things that we can look at here on the charts. You can see the current price 238.63, and the percentage down, or the percentage, whatever it's gone up or down in the day. And then right here, so you can see there's a daily, weekly view, monthly view. You can see over the past month just this massive decline here. I think the last 3 months. I mean, we were at the all-time high before all this stuff started, and then the coronavirus hit, and it just absolutely got demolished. So you can see it was up to $336, and now it's it's down $100. So that is a substantial decline. So this stuff down here is all pretty important. Generally, if you're looking at a corporation, you're gonna the market cap is pretty important. Let's look at a different company. Let's say we're looking to look at Disney. Um, it just gives you a little bit of a blur about like what the company is about, and then you can see the market cap, or the market capitalization. That is how much the company is worth. Number of employees, the price to earnings ratio, or PE ratio. This is a really important number because it basically describes either how much of a value or how overvalued the stock is. Generally, a stock with a PE ratio under 20 is considered pretty darn good. So this basically describes the price of the stock versus how much they're pulling in, and I think it's either revenue or profit. I can't recall. Um, a dividend is something that corporations will pay out to shareholders. I think quarterly. It varies depending on the company. But dividends are very popular for people, and they're like retirement accounts, because they get those. If you have enough stocks that pay dividends, you could literally just live off the dividends alone, which is pretty amazing. And then the average volume. This is important too. You want to know the volume that the stock is trading at, because it describes on average how many people are trading this on a daily basis. A stock with really low volume, that you could say that it is not going to have very much liquidity. So if you're just trading a couple shares or something, it's not going to be much of an issue. But say you had a really big position and you needed to unload all of that. You might have a harder time doing that with a very illiquid stock. Also, stocks that have a very low float, as they call it. A float is basically the number of shares that a company has distributed for sale, basically. A company that has a very low float may be easier to manipulate because one person could just come in there and move the whole market. Whereas with this, you got 33 million shares traded on average per day. That's what volume is the number of shares traded. It's going to be pretty hard for one person to come in and really move this thing on their own. So, and then looks like we've got some news feed stuff down here. Yeah, shut down Disneyland. So, Disneyland shut down in the past week or two. So that probably happened. What was that? Yeah, a couple days ago. So that was probably this tank where it dropped 12% in one day. I mean, for a company that's worth $171 billion and it drops 12%, that is like almost $20 billion that they lost in a day in their net worth. So pretty crazy. Robinhood is really good for just for generally trading and that kind of stuff. However, there's some things that are a little bit left to be desired. Their charts in particular, I do not particularly like. The line charts are only going to tell you the closing price at each of these times. But I prefer something that has what are called candles. So candlesticks are a little bit different. By the way, this is an app called TradingView. Also have a pretty good mobile platform, and this is going to be a lot better than actually looking at the charts on Robinhood. So this is we're looking at JNUG. I'm going to switch this to Disney just so we can kind of keep some fluidity here. So I've got a couple different things going on here. You might see all these graphs and everything at the bottom, and then all these wiggly lines and everything. I'm going to simplify some stuff, and I'm going to take off that. Okay. So, like I said, we're looking at Disney here, and I've got several different indicators, but I wanted to talk to you about what candlesticks are. So candlesticks kind of started back in Japan a couple hundred years ago, and it gives you just a lot more information than a standard line graph would. So how a candle works, I'm going to zoom way in here. All right, so how a candle works is, let's look at this one down at the bottom. So a candle is either red or green, depending on where the candle closes at. So the body of the candle is basically the open and the close. And then the wicks are just kind of where it moved in between. So this candle right here, if it's either red or green, depending on whether or not it opens or closes. Let me rephrase that. A candle is either red or green if it closes either above or below its opening price. So right here, this is where this green candle opened, and it closed up here. So that means it's green because it closed above its open. And then vice versa, this candle opened here, and it closed here. So it was red because it closed below the open. And then the wicks are just kind of where the candle had traveled in between. So generally, if you're trying to buy a stock that you're hoping is going to go up, you want to see candles that are generally going to be closing in the top 25%. This candle right here, this red one, is something that's called a doji, where it basically has kind of long wicks on both sides, and it represents indecision. So there's not really strength in either direction. Again, right here, you've got another doji. You can see that this one, this was a really strong bullish candle right here, and then we had some weakness. Probably the sellers that are trying to push it down again, and then we broke through, and then punched all the way up. I have another indicator right here. This thing is called Super Trend. This big green arrow, and it will give you kind of like buy or sell signals. So if we got the red line right here, this basically represents the line it needs to get broken in order for it to be considered a bullish market. A bullish market is when you think when something is really strong in an upward direction, or and then vice versa. A bearish market is something that's going down really strong. So you might hear someone say it's a bull market or it's looking very bullish. That means that it's going strong in the upward direction. So I will use super trend for some kind of like buy or sell signals. So I'm looking for when this red line gets broken here, for when I'm planning on entering, and then in vice versa, when this green line below gets broken, then that you want to close your position and get out. So that's just a very basic kind of technique that you might use, especially as a beginner, just to kind of gauge which direction the trend is moving in. They always say with trading, like, the trend is your friend, so you generally want to be trading in the direction of a trending market, not in a market that's really choppy. Like this right here, super choppy. You can see it's oscillating down, up, down, up, down. You definitely want to stay out of this stuff. This is actually what I might describe as what's called a trading range, where you kind of get what's called a resistance and a support area, and prices kind of bounce in between there. Resistance and support is really important and a valuable tool for traders. So what I will often do is I'll draw some lines in here. So you can see that this is kind of a support area, how prices are coming down and bouncing off. That means you've got buyers that are buying from this level again and again and again. And then also, because it's a trading range, we've got a resistance area as well. So you can see how prices went up, and you've got this long wick on the top here. So that shows that there are sellers right there, because prices went up, got rejected, sellers pushed it back down again, and it tested it again, pushed it back down again, prices move up, we get this really long wick. So this is what's actually called a bearish pin bar, because you've got a long upper wick, just showing that it's kind of a reversal indicator, because you know that there's a lot of sellers that when this tested this high again, the sellers pushed it back down. And then finally, I think it looks like the session closed right here, and then when it reopened, we gapped down the following day. So this would have been, so this is the 17th, the 17th, and then the 18th. So the market closed, and then there were a bunch of orders placed overnight, and then it gapped down, breaking through this support level. So it's definitely important to be aware of where there's resistance and where there's support, because if a major support level gets broken, usually it means that the market is going to kind of dump after that. And then vice versa, if a major resistance area gets broken, you're going to see a pretty big move upwards. So that's actually called a breakout, when there's either a trend line, which I'll describe here in a moment, or resistance or support area that gets broken, and then you usually get a pretty strong break, a little bit of a correction, and then it keeps on trending. One of the most important skills to utilize as a trader are trend lines. And what I mean by that is, when you're looking at a chart, let me get a trend line here. So when you're looking at a chart, you want to draw trend lines. Say if it's going up, where all the lows are at. So we've got a low here, got a low here, and looks like we've got a low there, and another one here. So what I'm going to do is I'm going to draw a line. Just going to see how that fits. Maybe bring it down a little bit more. So that fits pretty well right there. Okay. Yeah, I'll do something like that. So you can see how with trend lines, traders will use trend lines in order to pick their entries. So we had what's called a double bottom here, where prices hit the bottom and then they tested that low again. You had shorts that are trying to push it down even further. But then you've got buyers that are stepping up right at this level. Double bottom is a reversal pattern. So generally, if it makes a low and then it fails to break the preceding low, that's a pretty bullish indicator, because it basically implies that all the people that shorted in here, and I'll tell you more about shorting in a minute. All the people that shorted right here are now what's called they're trapped, basically. So you've got people selling again, and then the buyers are stepping up. Now all the people that shorted, or quote, like basically bet against the market, they have to buy stocks to close their position. I know this probably won't make sense. I'll explain more in a minute. And because all these people that are having to exit and buy the stocks to close their short positions, it just propels the market up that much faster. And just to kind of fill in a little bit of information, when you short a stock, you're betting against the market. So let's say I wanted to short Disney, and generally people that short, you've got to have like $2,000 in your account, and you have to have a little bit more trading privileges with your broker. But basically how it works is, let's say I think this support level is going to get broken and I want to short Disney. So what you do is through your broker can actually loan you shares in order to place your shorts. So you borrow shares from your broker. Say I borrowed 100 shares of Disney at this price right here, $92.46. You can see over on the right, it actually shows the price in the gray. So I shorted Disney at $92.46 or whatever. So my broker loans me shares. So I borrow them and I immediately sell them at $92.46. And then when the market tanks, I come down here, and then when I want to close my position, I buy back the same number of shares, 100 shares, and then I return them to my broker. My broker doesn't care because he's probably got 1 million shares of Disney or whatever. So being without his 100 shares for a small amount of time, he probably doesn't care. He just wants to hang on to his same quantity of stocks. So basically, yeah, you pay a small premium, you borrow the 100 shares, you sell them at $92.46, and then you buy them back at $79.66. So, and then you return them to your broker, and then you basically just made, whatever, $20 or $25 per share. Because again, you're selling them at 92, and then you're buying back the same number of shares at 79. So basically because it went down $22, you're making $22 in profit because you sold them here and then you bought them back. So the difference would be $22 per share. Basically, that's your profit. Hope that made sense. Sorry, I didn't know if I explained that very well. But yeah, shorting's a different game, and as you're first starting, you're mostly just going to be going long, or hoping stuff goes up. So same thing, long and short. It's kind of the same thing as like bull and bear. If you're going long, you're wanting stuff to be going up. If you're going short, you're wanting stuff to be going down. So yeah, basically that's kind of the premise. So we were talking about trend lines though. So drawing trend lines is a really key skill to know how to do. Like I said, because traders are going to be picking their entries off of these trend lines. So you've got, although, when the prices were right here, that trend line wouldn't really be there yet. But once it starts going up, then you can draw this trend line. So when the market continues further and gets to right there, you're going to have buyers that are coming in right at this area. Because you've got the trend line. Buyers are always going to be stepping up right at the trend lines. So that's a really great way to pick your entries. You know, you've got this double bottom, which is a great reversal signal. So then, prices are likely to continue going upward. And then you've got your trend line. So, that's where you want to be buying in at basically. However, this trend, it broke the trend line right here. When you break a trend line, that is a possible reversal signal. It doesn't mean just to enter without thinking about it, but if a market breaks a major trend line, that is an indication that things may be reversing basically. And then you also have, what I'm going to do is I'm going to copy, I can even select it, clone. Okay. So what I will often like to do is copy my trend line and make something of a channel, a trend channel. So you can use this to kind of plan your exits as well. And when you get a little bit of an overshoot to the upside, you're bound to get a little bit more of an overshoot on the other side. So with that, like I said, if you got an overshoot here, maybe you wouldn't decide to get in right at the trend line. Maybe you would decide to wait for it to overshoot a little bit and correct. But if you did, you would have been immediately trapped, and because markets started dropping again. Also notice, this is pretty crucial. So support and resistance, Mark Douglas, a famous trading coach, he said the market has a memory. So this resistance level right here, where the market was having a hard time breaking through, you can see how the market struggled at that exact same area. And then concurrently, you saw buyers coming in at this support level right here. So this pattern right here is basically, I think they call this like the two pipes pattern, or some people call them tweezer bottoms, because you've got basically a strong bullish candle, or excuse me, a strong bearish candle, this red one, and immediately followed by a strong bullish candle. This is a reversal pattern. So basically, you've got bears pushing stuff down really strong, and then the bulls firing right back with a fair amount of strength. Also, there's something called trend bars. So if the body of a candle, which this red candle right here is a really strong trend bar, because it like basically opened right here and closed right at the very bottom. You've got like almost zero wicks. So it basically means that there was a ton of selling right there, because it closed right at the very, very end. You want to be on the lookout for trend bars. If you ever get a whole bunch of overlap and dojis, like in here, overlapping candles are not very desirable, just because it connotes weakness. In a strong trending market, you should see nice, thick, like right here, boom, boom, boom. That just means people were selling like crazy right in this area, basically, because it was closing right in the bottom 25%, which is, if you're trying to short, that's what you want to be looking for, is candles that are closing in the bottom 25%. So we've got that, and then I can just kind of show you how we would draw the trend line. Whoops, didn't mean to do that. So if the market is going up, the trend line should be on the lows. If the market is going down, the trend lines should be on the highs, which I will show you. So like right there, there's a high, there's a high. So, I mean, that's technically kind of like where you would want to put that. I never draw off of the wicks. I mean, the opens and closes are the more important parts anyways, not where it went in between. So I know that doesn't fit perfectly, but if we come down here and do something like that, that tends to fit quite a bit better. So you can kind of gauge, and then you've actually almost got like a resistance area right there. So I can clone that. This is a support level, and then we've got a little bit of a tiny trading range right there. So you can just see this is completely how traders will gauge their entries and exits and stuff. You can see the long wicks on the bottom showing that there are buyers down here at this support level. And then you've got like this bearish pin bar, and a doji there. So you can see that you've got buyers at the, buyers and sellers. So some people will just trade in between trading ranges. Like they'll buy right here, sell right there, buy right here, sell right there. It's a little bit sketchy doing that sometimes. You never want to be buying in the middle of a trading range, always near the support. And you kind of want to wait until it bounces off and you can see confirmation before you do that. So yeah, that's a little bit about trading, trend lines and trading ranges, that kind of stuff. But you always really want to be aware of where your support and resistance is, and you can actually set alerts for yourself on TradingView. So let's say I was long right here or something, and I wanted to be aware if this support level gets broken. Well, I would come over here and I would say 87.77 or whatever the heck that was. Yeah, you can have it, be open-ended, send you an email, whatever. So TradeStation has all sorts of different plans. I think I paid like $150 a year in order to be able to use 5 different indicators on my chart. But I think the free one you get like 3 or something like that. So that's that. So that's gonna be the basic kind of fundamental technical analysis stuff. You can really dive deep when it comes to indicators. There's like thousands and thousands of different indicators out there. But when you're trying to actually pick your companies, let's kind of go through and look at some different companies and see how they're faring. So you want to be able to understand what the major market is doing. So generally, what I would recommend is just going to an index, which is what the SPY is. The S&P 500 is an index. So it's the 500 biggest companies on the stock market. And then an ETF is an exchange traded fund. So basically, it's a bundle of companies all mixed into one stock. So again, this is 500 biggest companies. The advantage of ETFs is that it defers risk. If one of these companies happens to, say they had a really bad year, it's not going to affect the price of the overall stock that much. You really have to see the entire market moving in one direction or another. So that's one cool thing about ETFs. They have ETFs for everything. They have like the NASDAQ, which is QQQ tracks a modified market cap weighted index of the 100 NASDAQ listed stocks. So this is the NASDAQ is primarily tech companies, and I think health companies that fit in there as well, like Apple. What else they got in there? Microsoft. Anyways, so those are the main indexes. You've got the S&P 500, the Dow Jones, which is like the top 30 companies in the stock market. Let's see here. So the Dow includes American Express, Apple, Boeing, Caterpillar, Chevron, Cisco, Coca-Cola, etc. So all those companies. So the Dow Jones is a mix of all these companies, how they're performing. You can see Apple's up like 11% today. IBM's up huge. This likely has to do with China faring a lot better. I know Apple has factories in like the Wuhan area. So with the Chinese seeing a lot less coronavirus now, Apple is bound to go up. So these are all sorts of market dynamics you want to be really aware of and you're doing your trading. I highly recommend Yahoo Finance. They have a 24-hour, not 24-hour, When the market is open, basically they have a news stream that I really, really like. You can see it right here. So they just will talk about what's happening in the markets, what companies are doing well, what companies are doing poorly, all sorts of technical analysis, that kind of stuff. You can stream this on your phone too. Watch it while you're getting ready in the morning or whatever. The market over here opens up at 6:30 a.m. Is it 6:30? I think it's 6:30. With Robinhood, I think you pay $5 a month, and it gives you access to pre-market trading. So you can actually trade like an hour before the main market opens, and I think there's a little bit after the fact as well that you can trade. So yeah, there's that, and they have all sorts of other tools you can use. Like heat maps. I definitely like heat maps quite a bit because they give you a nice visual understanding of what the market is doing, basically. So, the more green it is, the more it's going up, the more red, the more it's going down. You can see healthcare stocks. The whole healthcare industry is tanking pretty hard right now. And then what's doing well? So software, semiconductors, that probably has to do with everything in China getting better. What else? Specialty retail, that's Alibaba, big Chinese company, kind of like Amazon. So yeah, this is just a really good way to see what's happening across a variety of industries. Oil and gas looks like it's up quite a bit. Oil has been just absolutely tanking lately, but looks like it's starting to rally. I mean, look at those numbers. I mean, CEQP up 56%. That's just crazy. So understanding market dynamics and kind of what's happening economically through heat maps is going to be a really valuable tool. I also like another company, or another service I should say, called Simply Wall Street. This is how I first got started investing and picking my companies. If I can get it to load here. There we go. So Simply Wall Street is fantastic in giving you a lot of data in a very easy to absorb manner. That's what I like about it the most. So let's, since we're kind of doing Disney, let's pull Disney back up. All right, so this is something called the snowflake, and it gives you a visual representation of how the company is doing, how valued it is. Is it undervalued compared to its peers, or is it overvalued? Future, expected future returns, how it's done in the past, the health of the company, i.e. how much debt do they have, and how healthy of a dividend do they have. So yeah, you can see the major chart right there, and this is phenomenal. You can actually look and see these different colored dots, what has happened with the company at certain calendar dates. It's such an amazing tool. As an investor, there's all different kinds of trading. There's day trading, which is what I do, in and out in like 5 minutes, high frequency trading. Then you have swing traders, so traders that will hold usually for a number of days through the big market swings. And then you have investors, which they're looking long term, 6 months to 10 years. It can totally vary. As an investor, this is the stuff that you're going to want to be aware of. So like right here, legal issues, gender pay gap lawsuit brought by Walt Disney, So all this stuff is going to affect the market. If they have legal issues, it's going to affect their stock price. Earnings reports, especially super, super important. If they have positive earnings, 20,000 million. I'm not sure how to read that exactly. Versus 15. I think that's supposed to be billions. 20 bill versus 15 bill. So, and then you've got earnings, and then it spiked. So that's really, really common to see that kind of stuff. And then I need to close out of this. I wonder if I can get in here. Sorry, I'm just trying to get rid of this crap. Go away. Okay, cool. And so this is the stuff that I really, really like about Simply Wall. This meter right here, so you can see where the current price is versus its quote fair value. They've got algorithms and guys that crunch all these numbers. You can actually see how it went into it. I think click view data. So valuation, age free cash flow to equity. So they've got algorithms that calculate all this stuff to estimate, what they're probably worth. Pretty friggin' amazing. You've got the PE ratio here. You can see it's got a 16.8 PE ratio. It kind of gives you on a meter like how good is that, So you can see once it gets above a PE of like 30, it's not really considered very good anymore. Shows the industry standard PE ratio. And then I think it looks like the overall market, something like that. Price to earnings growth. So this is poor value based on its PEG ratio, price to earnings growth. So this is kind of based into what where it says future on the snowflake, what the expected growth of the company is in time. Price to book ratio. I think this has to do with like their price versus their number of assets, something like that. So obviously Disney has a ton of assets. Future growth projections, more growth forecasts, earnings per share growth forecast. That's earnings per share. That's like their quarterly earnings reports, I believe. Return on equity, so that's like how much money they're putting in versus how much they expect to get back out of it. Past performance, return on assets, just amazing, all this stuff. Debt to equity history, so they've got their debt pretty well under control, and their dividend payments. Dividends are just how a corporation shares its profits. Corporation's going to make a bunch of money. Some corporations will have no dividend. They're just all reinvesting. They're reinvesting all their profit back into the company. Whereas once a company gets into a specific size, they'll start distributing dividends. So they give those profits as kickbacks to the shareholders. So just know that you do have to pay taxes on your dividends. If you're holding a stock, you don't actually have to pay any taxes on it until you sell it. I know this is probably a lot of information, but so just to relate kind of, to bring everything kind of back together. So we talked about indexes and ETFs, some different companies that I'm looking at, for instance, are like JNUG. This is gold. So it's basically a stock that tracks the gold miners and what they're valued at, and this is leveraged. So with that 3x right there, that means that this stock will move 3 times what the normal gold stock does. And it looks like that tracks the whole industry right there. So yeah, leveraged stocks are a little bit dangerous because they'll move a lot more. You can see that move 14% today. So when it says bull, that means that you're wanting it to go up. They have other stocks like JDST. This is the same thing, but bearish. So when gold goes down, this stock goes up. You can see it went up 22% today, a ton. And then you've also got like DRIP. So this is a 3 times leveraged ETF on oil and gas, like natural gas exploration. So when oil goes down, basically, this thing goes up. And you've also got UWT. This is one that I'm definitely looking at right now. It went down a ton today because oil is still really weak, but it's 25 cents. You could get 1,000 shares of that. Look where this was trading a couple months ago. So back in December, it was trading at $14. If you go 5 years ago, I mean, it's trading at like $40 in the mid 2018, and it's trading at less than 30 cents now. So it's just absolutely insane. Once Russia and OPEC and Saudi Arabia come to a deal and they both raise their oil prices, this is going to skyrocket. So this is something that I'm definitely keeping an eye on. What oil is going to be doing in the next coming weeks. You've got Apple. This is just like a blue chip company, one of the most very safe stock. Obviously, they've got hit pretty hard since the trade war and trade wars in here, but since coronavirus. But a lot of people like these kinds of stocks particularly for like retirement funds and that kind of stuff. Penny stocks are generally anything that's going to be under like $10. A lot of small companies. There are a lot of companies that have done, a lot of traders that have done phenomenally well trading penny stocks. What I used to do, I would look on, let's go screeners, markets. Okay. So I would go to the different markets. These are all the different indexes: S&P, Dow, Nasdaq. The Russell 2000 is like the best companies under 200K or something. I forget. Very small companies. So you go to like trending tickers. This is the ticker symbol, by the way, these letters. So you can see, so I might go percent change and see what's up right now. So Zoom is up huge because, gosh darn it, don't do that. All these companies are like doing teleconferences now. I do not know why that keeps changing back and forth like that. It's really weird. Weird. All right. But this is a great place to come and just kind of take a look at what's really moving. Advance, I don't know what this is. Biotech companies will often have really, really big bursts, either up or down, because these drug trials that they're doing. Air New Zealand, God, down 35% today. That's just insane. Airline companies are getting hit extremely hard right now, obviously. But so biotech companies, you can actually look if you go to, let's see, where's that? Biofarmcatalyst.com. So you can check out what companies are in drug trials right now. I used to do this all the time. I would love doing this stuff. So it'll show, what companies are in what drug trials. So this is a migraine drug. They're in the phase 3 of their trials. So generally phase 1 is going to be like a very small study, very experimental. Phase 2, they expand it a little bit. Phase 3 is like confirmation. And then eventually they get to like, this company is getting FDA approval, looks like possibly. So I would look at this stuff all the time. And so you can see phase 3 top line data due first quarter of 2020. And then you can actually look, the ones that have a specific date are a little bit easier to track because you don't have to kind of like check on this stuff on a daily basis. But, if you have a company that has a really good drug trial result, it's going to just go up huge, and then vice versa. It's going to tank really hard if they fail a drug trial. Pharmaceutical companies have to go into insane amounts of debt in order to finance this stuff, often for years and years and years before they can actually start producing it and making money. Biotech companies will fluctuate quite a bit. I don't want to get this thing going too long because I know there's probably a lot of questions, and but I just kind of wanted to give you guys a general kind of kicking off point. And I want to talk about some of the important things to keep in mind. Some of the mistakes that I made when I first started trading. Never put too many of your eggs in one basket. You don't want to put all of your money into one stock. That's just really, really risky. If that one stock performs poorly, you're going to be down a lot. And then in conjunction, you don't really want to be putting too much money into one industry. Simply Wall Street is really good in that respect because it will actually show you the diversification of your portfolio. So I think I had a portfolio on here from a really long time ago. So if you, maybe not. Okay. Well, anyways, if when you if you use simply Wall Street to put all your stocks in there, portfolio, I think you can actually link it to Robinhood. It will show you kind of like little like your holdings, what stocks they are, and then little lines going over to what industry. If all of your stocks are going into tech, and then the tech market has a really bad day, all of your stocks are going to go down in unison. So you want to diversify yourself into different industries. Maybe put some into equities like the S&P 500. You put some into tech stocks, some into healthcare, some into insurance, finance, utility companies, whatever. You want to diversify yourself so you don't get hit too hard if something goes awry. So and also you want to trade within your as per risk allocation. A lot of people say you want to put no more than like 5% or 2% of your money into one trade. So that way you can kind of defer risk. Sometimes, I would break that in the beginning. If I saw something moving, I might go up to like 20% or something. But if you're really trying to build a portfolio rather than do kind of what I was doing in like day trading, swing trading, that would be ideal. And then one thing that's extremely important about stocks is something that's called the pattern day trade limits. Basically, what that means is if you have less than $25,000 in your account, you can only do like 3 day trades in a rolling 5-day period. So if you do a day trade on Monday, you've got to wait, I think, 5 days before that will roll off. So basically, that it's a really obnoxious rule, to be honest. It's designed to protect smaller investors from not over trading. But I think it can definitely hurt us in the long term. That's why I started trading futures, is because there's no pattern day trade limits. So yeah, basically that's something you want to be really, really aware of when you're putting on a position. If you are only looking at the daily charts when you're putting on a position, you're bound to get a lot more chop. You might want to go more like looking at the weekly charts to judge when you're going to enter and exit. Because if you're only looking at a daily chart, you might have gotten in this morning and you're already down and think, well, dang, I want to sell this thing. But if you do that, too frequently, you're going to get stuck. And if you get flagged for pattern day trading, they suspend your account for like 3 months. So that's something you want to be really careful of, is not, doing too many day trades. Over trading is also a definite problem. If you're constantly getting in and out of positions, you're going to end up hurting yourself. So you want to try and hold for at least a couple days if you can. Trying to think of some other mistakes that I made. And just ultimately, just really getting down on yourself. There's no magic wand. There's no holy grail of trading. You're always going to take losses no matter what. And unfortunately, it's just part of the game. So you don't want to do stuff like revenge trading, where if you're taking really big losses, you up your size to think, I need to make my money back. You need to have limits for yourself. Maybe have a limit for like, okay, if I make this amount of profit, I'm going to close my position. If I lose this much, I'm going to close my position. Also, setting stop losses. We can talk more about the details on that later, but I think setting stop losses is extremely, extremely important. So basically, let's say I entered right here, I would put my stop, just below it. So that way, if the market were to go lower than this position, it automatically closes my trade. You do want to be careful though. If you have, say you did 3 day trades, and you have a stop on, if that stop gets hit, well, dang, and you entered that day, dang, there's your 4th day trade. So just be careful about your stops, because that is technically an order. So you don't want to get flagged for PDT or pattern day trading because your stop is getting hit. If you have 3 day trades, I would not recommend trading anymore for that period of time, because let's say you enter a position and you've already done 3 day trades and it just tanks. Well, now you can't exit, because if you exit, you're going to get hit for PDT. So that's really important to keep aware of. And like I said, I trade on the futures market. This is the S&P 500. I know mine looks a little bit different. You can see some of my other charts. Just, I can see these are when people place big trades, I can see them. And then this is something called a volume profile, so you can see where the highest volume of trading has taken place. Anyways, it's a good idea to keep an eye on the futures market. The futures market, between Sunday night and Friday afternoon, the futures market trades 24 hours a day. So you'll get people that are trading futures during the Asian session, over in China, Japan, and the London session. So because futures are trading 24 hours a day, you can use that to your advantage, and you can look at say you just wake up in the morning before the market opens. So it's 5:30 a.m. You can see what futures did last night. And you can say, well, oil is still super down. Maybe I want to trade a leveraged short on the oil market. That's what DRIP was, where it said, where are we? Robinhood. DRIP. So this is a short. So you basically, you buy this stock, and instead of having to go borrow shares and everything and do that whole mess, you can just buy DRIP, which basically shorts the market for you. They've got all sorts of other stuff like SPXU. If right now, because the market's been so horrible, SPXU has been doing great because this shorts the S&P 500. So you can just buy this stock and it'll short for you without having to borrow any shares. I mean, it's gone up 100% in the past month. If you would have got in a month ago, you would have doubled your money already. So yeah, point being, looking at futures is really valuable. The futures market is also where people trade commodities, rice, soybeans, cattle, lean hogs, cocoa, cotton, lumber, all that stuff. And then you've got the equity markets, the Dow, S&P, bonds. You could look at, okay, bonds are up here, bonds are up here. You could go over and trade. Where are we at here? There it is. Like, say you saw bonds dropped a lot in the futures market overnight. Well, you could go and buy TMV. This is an ETF that shorts the bond market. Obviously, bonds went up a lot today, but these are just important things that you can use to your advantage when trying to develop your strategy. So looking at futures, what they did the night before, all that stuff. I mean, God, look at propane is up 53% today. That's just outrageous. 50% return in one day is phenomenal in anybody's book. So anyways, I'm just going to wrap it up here. Like I said, we've been at this for a while. I don't want to overload your brains. And a lot of this is just going to come from experience. And you really got to, study and watch videos on YouTube and you're going to take losses, but it's really, really important that you track your losses. You journal, like when you enter a trade, write down what your reasons, your justification was for entering. And then when you close a trade, log what happened. Go back and review your trades. That is the most important thing for learning is going back and looking at the charts and seeing what you did wrong. But that is, yeah. So anyways, I'm going to wrap it up. Just, be smart about risk management. If you've got any questions at all, feel free to reach out. And, but yeah, trading has been one of the most fun and intellectually challenging things that I've ever done. And it's equally as hard as learning to play an instrument was for me, guitar. But if you learn how to do it now, it can basically set you up for life. Because of compounding interest and everything, it's like having a piggy bank that goes out and collects more money for you throughout the day. And the bigger your account gets, the more it snowballs. And I mean, if you invest 20 grand, 60 grand between now and by the time you're 45, by the time you retire, you're going to have like $500,000 or something. So, it's just, a really, really valuable skill set, and it is an asset. You know, you're putting your money into an asset instead of buying it on new clothes or whatever. So I really do hope you guys pick it up. It is so much fun and so challenging, but also can be incredibly rewarding. So I really wish you all the best in your trading ventures. So good luck.